To use this approach to calculate the cost of equity, we need to be given three things about the common stock shares. The current stock price, so price per share today, the current dividend or the dividend that will be paid next time, and the dividend growth rate. This is all from chapter 8. We are just reviewing it. So let's review it on using this timeline. Let's say a company has just paid some dividend per share. Maybe it's $2 per share. The notation for the current dividend is D for dividend and subscript 0 for year 0. In 1 year, it's going to be a higher amount. It will grow by some percentage, which we denote by lowercase g. So the dividend in 1 year, D subscript 1, will equal D0, the current dividend, multiplied by 1 plus G, the growth rate. In 2 years, it will be even higher, and so in the formula, you will add the power 2 to the term 1 plus G. Year 3 from today, the dividend will be higher again, the power changes to 3, and so on in perpetuity. How do we find the stock price today, which we denote by P, capital P, subscript 0, price year 0? It's basically a perpetuity, present value, but it's not just a so-called level, flat perpetuity, it's a growing perpetuity. This was covered in chapter 6 in this class. See how many chapters we are reviewing in chapter 14? So the growing perpetuity present value formula says take the cash flow, the very first one in the future, so a year from now. In our case, that's the dividend in 1 year, D1, and divided by R minus G. So D1 could also be calculated by starting with what we know about the most recently paid dividend, D0, and multiplying it by 1 plus the growth rate in dividends. R in the denominator is the discount rate, and this is what we are also calling cost of equity in chapter 14. And G is the rate at which dividends are growing every year. Okay, so if we take this formula, and you can again imagine two versions of it, which is also how I was explaining this topic in chapter 8, with the first formula for calculating the stock price today, having dividend next year, D1 in the numerator, and the second version of the formula having instead D0 times 1 plus the growth rate in the numerator. So if you start with these formulas, you then want to rearrange it, each version of it, to solve for R, because R is the cost of equity, the discount rate. If you rearrange the first formula, you get R equals D1 divided by price 0, and then you add lowercase g to this fraction. Again, this is something that came up at the end of chapter 8, in which we were looking at how the return on a stock investment can be explained as, two sources of your the gain in your money, the dividend yield and the capital gains yield. Anyway, we're not talking about that this time. We are kind of just reviewing the sort of the basics of the return on stock investment. If you instead take the second version of the stock price formula using this dividend growth model approach and rearrange it to solve for R, which in this chapter is what we mean by cost of equity from the firm's perspective, then R will equal in the numerator D0 times 1 plus G, in the denominator price today, P0, and then to the whole fraction you add lowercase g, the growth rate in dividends. Okay, so P0 is stock value or stock price today, D0 is dividend that has just been paid or current dividend, D1 is dividend that will be paid next time, usually in 1 year. G is the annual growth rate in dividends in percent, and R is also in percent. That's the annual discount rate, or the return on stock investment from the investor's perspective, or in Chapter 14, from the firm's perspective, this is the cost of equity. Okay, so we have just reviewed the formulas that allow us to calculate the R, the cost of equity. Let's do some examples. Your company is expected to pay a dividend of $1.50 per share next year. There has been a steady growth in dividends of 5.1% per year, and the market expects that to continue. The current stock price is $25. What is the cost of equity? So you're given the dividend next year, the growth rate in dividends, and the current stock price. This is exactly the three things that you need in order to use. Let me go back to slide 14. In order to use the dividend growth model approach. For the other approach, which we will review next, it's completely different information that needs to be given. Okay, so let's solve this numerical example. Remember, we had a couple of versions of the formula to calculate the cost of equity using the dividend growth model approach. Because $1.50 is the dividend that will be paid next year, we use the version, so let's go back one slide, slide 17. We use the first one of the two versions of the formula to find the cost of equity. The one that says D1 over P0, and then you add lowercase g. So we are using this formula, and we just plug in all the numbers. No tricks here. The difficult part was, I guess, figuring out the right formula to use. And you just plug and check. $1.50 divided by $25. Then, once you have calculated this part, you add in decimals 0.051, the growth rate in dividends. And in decimals, you get 0.111. What does it mean? It costs the company 11.1% per year to use money, whatever the dollar amount is, received from common stock issues. So let's say if a company sells a share of stock with growing dividends to an investor who pays $100 to buy that share, then in return, every year, the firm will be paying $11.10 every single year forever. That's the annual cost to this company to use, the money, the $100 provided by the stock buyer. Next, the growth rate in dividends in the problem we just looked at was given. That was 5.1%. But what is this growth rate really? It's the expected rate of growth in dividends every year in the future. So how could anybody know what the future will look like? So we cannot really know the future growth in dividends every year in perpetuity. In real life, where would this growth rate in dividends in future years be coming from? Maybe we know the past growth rates. Let's say we look back at the last maybe 5 years, and we see the rate at which the dividends have been growing over the last 5 years, and maybe the growth rates were kind of close together, so we just take their average and say, okay, that's probably how it's going to continue into the future. So we use the past average growth rate in dividends. over maybe the recent number of years and use it as an estimate for the future growth rate, which is what the formula needs to have. For example, maybe to estimate the future dividend growth rate, we looked back at the last several years. For example, maybe to estimate the future dividend growth rate every year, we look back at the last several years, 2014, 2015, 16, 17, 18. And we already know how much money was paid in dividends per share at those points of time. So let's say in 2014, the dividend per share was $1.23. In 2015, it was $1.30. Then $1.36, $1.43, and $1.50. We don't know the growth rates, but we know the dividend amounts in dollars. Can we find the growth rates? Can we find the annual dividend growth rates? What about going from $1.23 in the year 2014 to $1.30 in the year 2015? What's the implied growth rate in this dividend amount? Well, I always tell my students in any class I teach, whether it's real estate or finance or econ, that the percentage change or the growth in anything is new minus old. That's the difference. Like in our example, that would be in dollars, right? The dollar change. And then to get the percentage change, you divide by the old number. So new minus old, and then you divide by old. So $1.30 minus $1.23, that's a 7-cent increase, right? And then you divide by $1.23, which is kind of your reference point, what you're referring to estimate the change relative to that starting point. And that's a 5.7% increase in the dividend amount. Then using the same new minus old divided by old calculation, we can calculate the actual growth in dividends from 2015 to 2016, $1.30 and $1.36. It's a 6% increase or a 6-cent increase, which is a 4.6% increase, or the growth rate in dividends for that year. Then for the year after, we have $1.43 minus $1.36 divided by $1.36. The increase in dividends was 5.1% over that 1 year period. And for the last year, the dividend went up from $1.43 to $1.50. That's a 7-cent increase. We divide that by $1.43 and get 4.9%. So how can we use these historical dividend growth rates for the last 4 years to estimate what we think the growth rate is likely to be in the future, like starting year 2019? Well, maybe we can just take the average of these 4 growth rates. So we take a simple average, 5.7% plus 4.6% plus 5.1% plus 4.9%, and then we divide the sum by 4, which gives us 5.1% estimated growth rate, lowercase g. So maybe in the previous example, where 5.1% future annual growth rate in dividends was given, maybe it came from this historical information on dividends over the last few years. Okay, so the dividend growth model approach was one of 2 formulas that we can use to calculate the cost of equity, which is how much it costs the firm every year to use money provided to it from the investors who bought its common stock shares or equity. Let's summarize the advantages. According to the book, it's easy to use. Okay, no other advantages, I guess. Disadvantages, if you think about it, what does the formula require us to know? The dividend in dollars, either today's or next year's, the growth rate in dividends, and then today's stock price. If you just look back at the formula, you will see that those were the three things. So how about companies that are maybe temporarily not paying any dividends? Then we don't know the dividend amount in dollars. Can we use this formula? No. So what can we use? We'll have to use something else. Also, another disadvantage of the dividend growth model approach is that it's not applicable if dividends are not growing at a reasonably constant rate, because the formula kind of forces the growth rate, the lowercase g, to be the same every year in the future in perpetuity. Then the third disadvantage is that the cost of equity calculation is extremely sensitive to the estimated growth rate in the dividends. So if we are a little bit off in, like, maybe we are 1% off in what we are using for the G, right, the growth rate in dividends, then we will also be 1% off in our cost of equity. And that might be like the difference in like tens of thousands of dollars from the firm's perspective. Then another disadvantage is that the formula does not consider the risk of the cash flows to the stockholders. Because technically, you know, high risk, high return, this term, I've been using it a lot during my last couple of chapters. So, and we're talking about return, although from the firm's perspective, the cost of equity. But where is the risk part? So this formula doesn't consider risk at all. But the other approach that we will switch to on the next slide does consider risk.